Okay, on the 17th, paid creditors on account, $6,450. Okay, you guys, again, we're looking for keywords in the transaction to help us pick out which accounts were affected. Right off, I see the word paid, so that lets me know that cash was affected. Who are we paying cash to? We paid creditors on account. Well, the account that represents what we owe creditors on account is accounts payable. So our two accounts would be cash and accounts payable. So let's look over here. Cash is an asset, accounts payable is a liability. Well, if we paid creditors part of what we owe them on account, we would now owe them less on account. So accounts payable is a liability that decreased. Liabilities decrease on the debit side. So what we're going to do is debit accounts payable, because if we pay creditors part of what we owe them on account, we now owe them less on account. Accounts payable is a liability, and they decrease on the debit side, and that's $6,450. If we paid creditors part of what we owe them on account, then cash of the business decreased. Cash is an asset. Assets decrease on the credit side. Okay, the 20th, we're dealing with a return. It says, return a portion of the office supplies purchased on April 2nd, receiving full credit for their cost, $325,000. Okay, if we're returning office supplies, then certainly the office supplies account would be affected. Now think about how a return works. If you go to let's say Lowe's and purchase an item for cash, you get home and that particular item, let's say it's I don't know, a refrigerator. The refrigerator won't fit into the space in your kitchen, so you return that refrigerator to Lowe's. You've got your receipt, you paid cash. As long as you haven't damaged it, they would typically give you your cash back. But now let's say instead of paying cash, you paid for that refrigerator with a Lowe's card or bought it on account. Then when you return the refrigerator, they're not going to give you cash back. They're going to decrease the balance you owe them on the Lowe's card. Well, we've got a similar situation here. This transaction on the 20th refers back to the 2nd, where we purchased office supplies on account, $2,300. Of those office supplies, on the 20th, we returned $325 worth. So the two accounts affected on the 20th would be the same two accounts affected back on the 2nd. So if we return part of the office supplies purchased on the 2nd, which were purchased on account, then we now owe that creditor or that business less on account. Our accounts payable balance to them has decreased. Accounts payable is a liability account. Liabilities decrease on the debit side. So we're going to debit accounts payable for $325. It's a liability account that decreased, it gets the debit. Office supplies of the business also decreased. Office supplies is an asset. They decrease on the credit side. So really what happened here, you guys, I went through the rules of debit and credit, or went through our 3 steps. I picked out which accounts were affected, decided for each account affected whether it increased or decreased, and then I plugged it into our system and entered it in the journal. But on one like that, where you're dealing with a return, you would make the opposite journal entry from the purchase for the amount of the return. And that should make sense because a return is the opposite transaction from a purchase. Okay, moving on. On the 23rd, paid advertising expense $4,300. Okay, our first word is paid. That tells me cash was affected. Then what do we pay for? Advertising expense. Well, that would tell me the advertising expense account was also affected. You guys remember our revenue accounts, expense accounts, and dividend accounts all begin the year with a zero balance. Every time we earn revenue, we increase the revenue account balance. Every time dividends are paid, we increase the dividends account balance. And every time a cost is incurred for a particular expense item, we'd increase that expense account balance. In other words, our advertising expense for the year has now increased. So let's go over here. Our advertising expense is an expense account that has now increased for the year. Expense accounts increase on the debit side. So we're going to debit advertising expense for $4,300. And we're going to credit. We debited advertising expense because it's an expense account that has increased for the year. We're going to credit cash, an asset that decreased. Remember, assets decrease on the credit side. Okay, our next little note there says enter the following transactions on page 19 of the 2-column journal. You guys, I'm not switching to a new page. They made this one page 18. It's obviously not page 1 because the business had transactions prior to April. 18 is just the number they picked. I'll pick one for you on your journal form on the test. But don't worry about skipping to a new journal page. I don't really see the point there. Let's just go with, we're still on the same page, so we're going to continue with 18. Okay, on the 27th, excuse me. Sorry for all the coughing and sniffling. I seem to have a bit of a cold or something. On the 27th, discovered an error in computing a commission. Received cash from the salesperson for the overpayment, $2,500. Now, let me read into this a little bit. We're on the 27th of April, and it's probably, if we're paying our sales staff once a month, it's probably about time to pay them again. So in making those calculations this month, we realized in March we screwed up. We overpaid someone by $2,500. Now, first off, that's a bad situation. If you're the salesperson and you were overpaid $2,500, you probably should have realized it and told your employer. If you didn't, it makes you look somewhat dishonest. But you could play dumb, pretend that you thought you were due that money. But then if you spend it, you still have to pay them back. So it's a bad situation all the way around. It's better to do that correctly to begin with. But what's happened, we're almost a month later, and we figured out last month we overpaid a salesperson by $2,500. Now it goes on to say we received cash from the salesperson for the overpayment, $2,500. Well, that tells me we now have more cash. They paid us back. So cash was affected. The other account affected would be salary and commission expense. Okay. Cash of the business has now increased. The salesperson repaid us. Cash is an asset, and assets increase on the debit side. Salary and commission expense, though, for the year, salary and commission expense has now decreased. We increased salary and commission expense last month by $2,500 too much. Now, to correct the error, we need to decrease the salary and commission expense balance by the amount we overpaid the employee. They've now returned that to us. So salary and commission expense for the year has decreased because of the overpayment and subsequent repayment by the employee to the company. Expenses decrease on the credit side. So we're going to credit salary and commission expense. For the same amount, $2,500. Why? It's an expense that decreased. Now that's not typical, you guys. Expenses normally start the year with a zero balance and increase throughout the year. For an expense to be decreasing, it's some type of oddball transaction. Like here, we're correcting an error from last month. Okay, on the 28th, paid automobile expense, including rental charges for an automobile, $1,500. The first word's paid, so that tells me that cash was affected. What did we pay for? We paid automobile expense, so that tells me automobile expense was affected. They try to throw you off and get you to pick rent expense because they say rental charges for an automobile are included here. We're going though with automobile expense, which is an expense account. Automobile expense for the year has now increased. Expenses increase on the debit side. $1,500. Okay, if we paid for automobile expense, cash of the business decreased. Remember, cash is an asset, and assets decrease on the credit side. On the 29th, paid miscellaneous expenses, $1,400. The first word's paid, so that tells me cash was affected. What did we pay for? Miscellaneous expense items. So the account I'm going to pick is miscellaneous expense, which is, of course, an expense account that has now for the year increased. Expenses increase on the debit side. So we're going to debit miscellaneous expense. It's an expense account that increased on the 29th by $1,400. And cash, let's go back. Remember, cash is an asset. If we paid miscellaneous expense items, then cash of the business decreased. Assets decrease on that credit side. I'd been just talking you through that one, but I thought it might not hurt to go back and look. Okay, on the 30th, recorded revenue earned and billed to clients during the month, $57,000. Okay, what's happened, you guys? Elite Realty has provided service to customers all month long. Now we're at the end of the month, and they're figuring out what we've earned from customers for the month. They want to record that as revenue, but also they want to bill the customers so that they pay us for those services provided. So let's look for key words. The first three words are recorded revenue earned. Well, that should tell you your revenue account was affected. Our only revenue account here is fees earned. Okay, if we're billing customers, then we must have already earned that revenue. Remember, we record revenues when they're earned from customers. We're not going to send them out a bill if we haven't already provided the service. So we can feel good about recording the revenue. Also, if we're billing clients, then accounts receivable would be affected. If we're sending out bills, customers now owe us more on account. And that should make sense. Let's say if you go to your mailbox this afternoon and you have a bill in it from Verizon. Once you open your mailbox and look at that bill, you feel like you now owe Verizon more than you did before you went to the mailbox, right? So if this company's sending out bills, their customers now owe them more on account. Our two account, and then the account that represents what customers owe them on account would be accounts receivable. So our two accounts affected here are accounts receivable and fees earned. So let's look at it. Accounts receivable is an asset account. If we're billing customers, they now owe us more on account. So accounts receivable is an asset account that increased here. Assets increase on the debit side. And that was $57,000. Okay, what about revenue of the business? Well, the business, if they're sending out bills to customers, they've now earned more revenues for the year. Fees earned is our revenue account. Revenues earned by the business for the year have now increased. Revenues increase on the credit side. So we're going to credit fees earned. So why did we do this? If we're billing customers, what customers owe us on account has now increased. So accounts receivable has increased. It's an asset. It gets the debit. We've now earned more from customers for the year. So fees earned, our revenue account also increased. Revenues increase on the credit side. You guys will finish up our journal entries and start with a posting process in the next video. Thanks.